So technology is impacting every sector, and surely insurance is no exception to that as well. But I think it's important to remember what an insurance policy actually is. It's a piece of paper that says if something bad happens in the world, you get some money as a result of that. And those bad things can happen because of things like accidents, human negligence, natural catastrophe, terrorism, events like that. And as great as the sort of tech giants are, they're not going to be able to remove those things from happening. So as long as risk remains in the world, I think insurance remains very relevant. That said, there are obviously parts of the insurance market that are going to have some threats from technology, some with opportunities. So on the threat side, driverless cars is obviously going to impact the long-term future of car insurance. It's one of the reasons why we have a very light weighting in our portfolio to car insurance and home and personal lines in general. On the commercial line side, where we do invest more, things like artificial intelligence, machine learning, that really does add an incredible new tool to the toolbox of our companies, and we really do think they can take advantage of that. And it's important to remember, in some ways, insurers are the original data companies. Yeah, I do think the M&A trend will continue. We've seen it over the last few years. It really started in reinsurance, and particularly the consolidation of many of the Bermudan companies. We then saw a whole spate of international groups looking to increase their US specialty businesses. We saw some acquisitions of Lloyd's of London-based companies and some US players as well. And then this year we've seen a couple of more sizable deals with AIG buying Validus, with AXA buying XL Catlin. They're much more strategic in nature, and I think we will see that continue. And valuations are certainly conducive to that. You know, for the US property casualty insurance industry, we're trading a little bit above 30-year averages, so that's going to help. And also, the pool of buyers is widening as well. Post the US tax reforms, the US corporates are now much more on a level playing field with their European and Asian counterparts. So that's one reason why we've seen the likes of AIG and also Hartford over the summer step in to make acquisitions. Yeah, we have seen a lot more volatility in recent times when it comes to weather, extreme weather and catastrophe activity to some extent. And I think it's important to remember that one of the reasons insurers exist is to take away that volatility from individuals and from companies as a result of those kind of things. So I think it gives the industry an opportunity to remind its customers as to why they exist. So from an insurer's point of view, actually increased weather is not necessarily a bad thing as long as you can appropriately price for that. So we have seen premium rates rise in those areas of business, and in some cases companies actually buy more reinsurance themselves to take off the volatility of those weather events in terms of their own earnings. Catastrophe bonds are really just almost a financial market version of reinsurance. That they're there to effectively pay out if the wind blows or the earth shakes. Given the fact that collateralized bonds are collateralized, it does mean that they do play in the parts of the market where there is some likelihood of loss, and it tends to be more of a binary outcome. You could lose potentially all of your capital. Now, if you go back post financial crisis, the coupons that were available on catastrophe bonds were typically double digit. The expected loss was probably 2 or 3%. So arguably, you're getting paid for the risk you're taking on. You fast forward to today, cat bond yields are probably in the 4 to 5% range. The expected loss is largely the same. So I would question whether you're really being appropriately paid for the risk. I think if you look over the long term, a well-balanced insurance portfolio could probably deliver just as steady returns. And if you look at our own fund in the last 10 years, we've done about a 13% compounded return. That's about 5% better than the Swiss Re total return cat bond index.